Britain is broke. Not the kind of broke where you skip a holiday. The kind where the government is paying more to borrow money than it has since the entire banking system nearly collapsed in 2008. And the worst part, most people have absolutely no idea it is happening. Let us start with the cost of borrowing. When a government needs money, it raises it by issuing bonds. In the United Kingdom, these are called gilts. Investors buy these bonds, and in return, the government pays them interest. Now, the question is, who decides what rate of interest has to be paid? Largely, the market does. When investors feel uncertain or nervous about a country's economic situation, they demand a higher rate of interest before they will buy that country's bonds. The logic is simple. Greater risk must come with greater reward. And right now, that is exactly what is happening with the United Kingdom. The yield on 10-year government bonds has reached a level not seen since the financial crisis of 2008. This is not just a number. Behind that number lies investor anxiety, doubt, and a genuine sense of unease about where things are heading. The year 2008 is one that most people remember. That was the year the entire Western banking system came close to collapse. The fall of Lehman Brothers, the subprime crisis in America, the shockwaves that rolled across to Britain. The fact that borrowing costs have returned to the levels of that period tells you something important. The situation today is serious. But it is worth noting that the nature of this crisis is different from 2008. Back then, the banks themselves were drowning. This time, the problem is a widening gap between what the government earns and what it spends, and the rising cost of financing that gap. It helps to think about this in simple terms. Imagine your monthly income is a fixed amount, but your expenses are consistently higher. You borrow to cover the difference. But borrowing means paying interest. Next month, your costs are even higher because the interest payments have been added to the pile. A cycle begins. The UK government is caught in something resembling that pattern. Spending is going up. Revenues are not keeping pace. So the deficit grows. To fund the deficit, more borrowing is needed. And the cost of that borrowing is now at a level not seen in many years. What does this mean for ordinary people? It means that money the government might have spent on healthcare, education, road repairs, or welfare support is instead going toward servicing debt. It is a kind of invisible tax. You do not see exactly what proportion of your taxes goes toward paying interest on old borrowings. But it is going there. And the more that has to be paid in interest, the less is left over for the things that matter to people in their daily lives. Now let us look at what happened in February with the government's borrowing. In February, the UK government borrowed £14.3 billion. That is a large number on its own. But the real problem is not the size of the number in isolation. The problem is that it came in much higher than expected. Economists, analysts, and the government's own financial watchdog had not anticipated borrowing would reach that level. This overshoot means that the government's financial plans are not playing out as designed. The Office for Budget Responsibility, which is the independent body that scrutinizes UK public finances, works with the Treasury towards specific targets. When borrowing runs this far ahead of those targets, the government faces a narrow set of options. It can cut spending, it can raise taxes, or it can borrow even more. None of these options is easy, none of them is popular, and each comes with its own consequences. Cutting spending might mean reducing budgets for public services that are already stretched thin. The National Health Service is under enormous strain. Waiting lists are long, staff are exhausted. Cutting funding further in this environment would make a difficult situation worse. Raising taxes means taking more from people who are already finding it hard to make ends meet, given that the cost of living has been so elevated in recent years. And borrowing more simply pushes the problem forward, adding to a debt burden that future generations will have to deal with. The political pressure around all of this is intense. The opposition argues the government is incompetent. The government says it inherited the situation. This argument goes back and forth, but ordinary people's lives do not pause while politicians debate. The consequences are felt in real time, in real homes, in real communities. The third pressure point is energy prices. Tensions involving Iran have been building, and any instability in the Middle East has a direct effect on global oil markets. The region is a major source of the world's crude oil. Iran itself is a significant producer, and the shipping lanes that pass through the Persian Gulf and the Strait of Hormuz are among the most important in the world for the movement of oil and gas. If conflict escalates, or if shipping through those waters is disrupted, global supply can tighten. When supply tightens, prices go up. When oil prices go up, petrol and diesel get more expensive. When transport costs rise, the price of almost everything rises alongside it, because goods have to travel from factories to warehouses to shops. When gas prices climb, heating a home becomes more expensive, and electricity bills follow. The United Kingdom has already been through an extraordinarily painful period of inflation. Between 2022 and 2023, inflation climbed into double digits. People were genuinely struggling. Food prices, rent, energy bills, all rising at once. The Bank of England raised interest rates repeatedly, bringing inflation down only through a slow and painful process. That process is not finished. Inflation is still above the target. And if energy prices surge again because of geopolitical events beyond anyone's control, all that hard work could be partially undone. It is worth understanding just how difficult the challenge is of fighting inflation while also keeping an economy moving. To bring inflation down, a central bank raises interest rates. Higher interest rates make borrowing more expensive. When borrowing is more expensive, businesses invest less. When businesses invest less, they hire fewer people. When fewer people are hired, households have less money to spend. When households spend less, demand in the economy falls. When demand falls, economic growth slows. The medicine for inflation, therefore, carries its own side effects. It slows the economy down. The Bank of England is caught in exactly this tension. It would like to begin cutting interest rates to give the economy some relief. But it cannot do that responsibly if inflation is still too high. And if energy prices push inflation back up, the moment for rate cuts gets pushed further away. Higher rates for longer means the government's borrowing costs stay elevated. The three pressure points we started with feed into each other and make everything harder to resolve. Economists have a word for the scenario that is being quietly feared. The word is stagflation. Stagflation means a combination of high inflation and low or stagnant economic growth happening at the same time. It is the worst possible combination because the usual tools do not work well when both problems exist simultaneously. If inflation is high but growth is fine, you can raise rates to cool things down. If growth is low but inflation is under control, you can cut rates to stimulate activity. But when both problems are present together, raising rates fights the inflation but hurts the growth, and cutting rates helps the growth but stokes the inflation. There is no clean answer. Britain lived through a version of stagflation in the 1970s. Oil prices spiked. Inflation climbed sharply. Growth stalled. Labor strikes brought the country to a standstill. The government had to go cap in hand to the International Monetary Fund. That history has not been forgotten. The situation today has not reached those extremes, but the direction of certain indicators is enough to make serious people nervous. It is also worth looking at some of the deeper structural issues sitting underneath these immediate pressures. Since Brexit, the relationship between the UK and its largest trading partner, the European Union, has changed significantly. New barriers to trade have been introduced. Smaller businesses that relied on frictionless movement of goods across borders have found themselves dealing with more paperwork, more delays, more costs. The free movement of labor that once allowed businesses to hire from across the continent has ended. The health service, the hospitality industry, agriculture, logistics, all have felt the effect of reduced labor supply from Europe. The pandemic left its own mark. The government spent heavily to protect people and businesses through those years, and rightly so. But that spending added substantially to the national debt. The echoes of that borrowing are still being felt in the public finances today. The war in Ukraine sent energy prices to extraordinary heights in 2022. And even though prices have come down from those peaks, the shock that passed through the economy in the form of inflation has not fully healed. Globally, the picture is also complicated. There is uncertainty about the direction of economic policy in the United States. China's economy is not growing at the pace that had been expected. Trade tensions between major economies are rising. In this environment, international investors become cautious. And when they become cautious, the cost of borrowing for governments like Britain's tends to go up. Let us think about what all of this feels like for real people. Those with mortgages have felt the impact most directly. When interest rates rose, monthly repayments went up. Many families across Britain have seen their mortgage payments increase by hundreds of pounds each month compared to what they were a few years ago. That money has to come from somewhere, and it usually comes from cutting back on other things. Fewer meals out, fewer holidays, smaller grocery shops. The ripple effects spread quietly through the whole economy. Renters have not escaped either. When landlords face higher mortgage costs, many pass that on in the form of higher rents. Rental prices in many parts of the country have risen sharply. In London, the cost of renting even a modest flat consumes a huge proportion of most people's monthly income. The pressure on household budgets is real and persistent. For younger people, the situation carries a particular kind of frustration. The dream of owning a home feels further away than ever. House prices were already high. With borrowing costs elevated, the monthly cost of a mortgage on even a modest property is extremely challenging on typical salaries. Many young people have resigned themselves to renting indefinitely, which has consequences not just for their personal finances, but for their sense of security and their ability to plan for the future. Businesses, especially small and medium-sized ones, are also feeling the squeeze. When the cost of borrowing is high, investing in growth is harder. Buying new equipment, taking on extra staff, expanding into new premises, all of these things become more expensive to finance. Businesses that might have grown are instead standing still, or in some cases contracting. This has long-term consequences for productivity, which is a subject that has dogged the British economy for well over a decade. Productivity is essentially about how much value is created for every hour of work. Since the financial crisis of 2008, the UK's productivity growth has lagged behind many comparable economies. This matters enormously because strong productivity growth is what allows wages to rise without triggering inflation. If workers produce more value, they can be paid more without the business having to raise prices. But when productivity is weak, wage growth either gets suppressed or it feeds into inflation. Britain has been struggling with this challenge for years, and the current environment is not making it easier to address. The pound sterling is another indicator worth watching. A currency's value reflects confidence in the underlying economy. When investors lose confidence, they sell the currency and move their money elsewhere. A weaker pound makes imports more expensive. Britain imports a significant proportion of what it consumes, from food to manufactured goods to raw materials. A depreciating currency, therefore, adds to inflationary pressure from another direction, compounding the problem that already exists from energy prices. There are things the government can do. Targeted spending reviews that redirect resources toward areas with the highest economic return, rather than cutting indiscriminately. Tax reform that broadens the base and improves efficiency without simply raising headline rates. Investment in skills and training so that the workforce is better equipped for the demands of a changing economy. Long-term commitment to clean energy so that Britain is less exposed to the volatility of global fossil fuel markets. Structural reforms that make it easier to build homes, which would ease housing costs and free up household budgets. None of these things produce results overnight. An economy is like a very large ship. You can turn the wheel, but the course takes time to change. In the meantime, people are living with the consequences. That reality cannot be wished away. It has to be acknowledged, and it has to shape the urgency with which decisions are made. History does offer some reassurance. The United Kingdom has navigated serious economic difficulties before. The devastation after the Second World War, the stagflation of the 1970s, the recession of the early 1990s, the global financial crisis of 2008, the economic shock of the pandemic. Each time recovery eventually came. But each time the quality of the decisions made during the crisis shaped how quickly and how fairly that recovery happened. The lesson from those episodes is that short-term political thinking tends to make things worse. Decisions made to win the next election rather than to set the country on a sound long-term footing have a habit of coming back around. What is needed right now is a willingness to have honest conversations about difficult trade-offs, to invest in things that will take years to bear fruit, and to make the burden of adjustment as fair as possible across different parts of society. For individuals navigating this environment, a few things are worth keeping in mind. Being cautious about taking on new debt makes sense when borrowing costs are high. Keeping some financial buffer in place, if circumstances allow, provides resilience against unexpected shocks. Understanding how changes in interest rates, inflation, and government policy affect your own finances helps you make better decisions and advocate more effectively for good policy. Economics is not something that happens only in spreadsheets and committee rooms. It happens in every household, in every payslip, in every supermarket trolley, in every energy bill. When national economic conditions deteriorate, that deterioration reaches into the most private corners of people's lives. Understanding why it is happening and what might be done about it is part of being an engaged and informed member of society. The UK economy is under pressure. The borrowing costs, the fiscal overshoot, and the energy price risk are not small or trivial concerns. They are serious challenges that will require serious responses. But they are not insurmountable. With clear thinking, honest communication, and a genuine commitment to long-term economic health over short-term political comfort, there is a way through. It will take time, and it will take effort, and it will require more from everyone than anyone would choose. But the destination, a more stable, more productive, more resilient economy, is worth working toward. That is where things stand today. The pressures are real, the risks are real, and the decisions that get made in the coming months and years will determine how this chapter in British economic history ends. Thank you for listening.